Earnings week continues, and today we are focusing on 3M with some massive news of a dividend cut. In today's episode, we are going to take a look at this company. Now, they have in fact also reported their earnings, and as we can see, favorably up nearly 4% in the market. So we're going to take a look. Why is a dividend cut happening? Is it strong undervalued buy now given the very good earnings? As always, we'll look at the company, we'll analyze their top line revenue growth, their bottom line net income. We'll also look at the health of this company, their total cash versus their total debt. We also want to focus on the dividend safety. Now, whilst there is a reduction in the dividend, we also want to look at some other underlying metrics, their free cash flow growth, their debt levels as well, very important for this company. And as always, we'll look not just what insiders are doing in terms of buys and sells, but also what the massive institutions are doing, so we can get some sense of where this company is going over the next few years. We'll also take a deep dive not just into their earnings and how strong it was, but we also want to look into their Q1 investor presentation deck. And the important thing is talking about their dividend, as a lot of investors were hoping that this wasn't to be cut. We'll take a look at also their guidance for the next year. As always, we will run them through the valuation model. We want to get to our intrinsic value of 3M. We want to get to our acceptable buy price, our investor margin of safety, as well as what Wall Street are forecasting over the next 12 months. Now, we can jump in at a very high level at how their earnings was, and this is one that we do hold in our own portfolio, so we will also discuss what we are planning to do towards the end of the episode and our strategy moving forwards. Now, the first thing we want to point out from this article, and it will also be discussed in the investment deck, is essentially their dividend payout are expecting to be around 40% of their adjusted free cash flow. Now, this is typically a positive sign. As we always say on the channel, we ideally want to see the free cash flow payout below 60%. Does give us faith then moving forwards that management are able to offer those double-digit dividend increases. But what it ultimately leads, when we look at the historical performance, it has been a lot higher, and therefore the current yield will be reducing. But we'll touch upon that in the later episode. Now, when we take a look at how they've actually performed, well, their earnings per share was $2.39, a very strong beat when we compare analyst expectations of $2.10. And we also note they beat on their revenue 7.72, although marginally, as we key, analysts were targeting 7.63. So a positive sign if we purely look at the earnings in terms of a beat on both earnings per share as well as revenue. We also note they are lowering down that free cash flow payout, and something we haven't mentioned but have discussed in previous episodes is the fact that in 2023 they did reduce a lot of their costs by doing a global workforce reduction of 10%. Now, when we look at the historical performance, we can see it is down even after today's pop of 4%, just over 9%. Over the last 10 years, however, it is down not just nearly 32%, but has been coming downwards since the highs of January 2018. So we are talking about over 6 years ago at a price of $259. Now, we do know we have 3 ratings, all the same from analysts: a hold from Seeking Alpha, a hold from Wall Street, as well as a hold from Quant as well. Now, in terms of where it currently sits, it is in the mid to lower end of the 52-week range, and right now it does offer a yield of 5.48%, but as we discussed, this will be lowering, and the forward PE does sit around 12.3, significantly lower than the S&P 500, which sits around 21.5. Now, in terms of the company and the growth, whilst we understand the spin-off has occurred now, it is fully complete, it is one we can still look at just prior data just to get a gauge of the growth of the company, how it has been. And we note from 2014, whilst we like to see a minimum of 3 to 4% year on year, it has moved marginally from 32 billion to around 32.7 in 2023. And when we look at it in this graph, we can see it has been pretty stable, which isn't something you want to see from revenue. When you factor in inflation year on year of around 4%, as that was the US inflation rate on average over the last 40 years, you will note for 3M, they have essentially had decreasing revenue in real terms. What about the bottom line? Because we can have a flat top line with increasing bottom line, but what we in fact note, it has gone from around 5 billion in 2014 to a net loss of just under 7 billion in 2023. And when we do again take a look at it on a graph format, we do note it has been pretty stable as well when you do exclude December 2023. So We are talking about a company that, yes, essentially it has been offering a very nice yield over the last few years, over the longer term. In fact, when we look at their actual numbers and do a deeper dive, we do notice a trend where it is very stable and very flat. Now, how does the health of the company look? Their total cash versus their total debt. We note cash and short-term investments, $3.3 billion to just under $6 billion in their latest quarterly report, and the trend over the longer term has been an increase in cash balance. Now, doesn't tell us much until we analyze their total debt numerically and directionally, and what we can see on a total debt perspective, it has increased from around $7 billion in 2014 to 16.942, and we can note again, similar to the cash, the total debt trend is also increasing. Now, given the spin-off, a lot of debt was passed on to the essential new company, Solventum, so we will look at their investor presentation to see how much does remain into 3M. A few things we can take a quick look at is their earnings and the expectations over the next few quarters. Now, whilst we do note that beat that we just talked about, as well as a year-on-year increase, we do note the expectation over the next few quarters, whilst it may be an increase from quarter to quarter, or in fact slightly inconsistent, we do note on a year-on-year basis, there isn't expected to be growth. So there is a lot factored into this company. You do need to understand in terms of there are some real things just to consider. They may not be negatives, but definitely things that you need to be incorporating, not just into your own investment thesis, but also into your own margin of safety. Now, valuation, we do look at the underlying metrics, but we see an A- straight away. When we try to look at the information behind this, well, on a non-GAAP basis, forward P 12.3, it is significantly lower than the sector median, which comes in at just under 19. And when we do take a look on a GAAP basis, forward looking, it is very similar, very low at 13.24 when you do comparatively compare it to the industry leaders of 21.16. So while you may look at other factors, you can see it very mixed depending on the valuation model that you use. Overall, it does look very cheap when compared to the median of the sector. How about the growth grade? Well, not something you really want to see, a D-. Now, the reason for this, year-on-year growth, negative 4.5%. Forward looking, negative double digit, and we can see on a both year-on-year basis as well as a forward basis, the industry leaders, the median of them, do have single-digit positive growth. Now, we can also note that when we look on a free cash flow per share growth rate as well, forward-looking, that is expected to be negative. Again, sector media, strong double-digit growth. And one thing I always like to point out is the earnings per share growth over the longer term, 3.6% for 3M. However, what we note, sector median, double-digit at 12%. So there is, yes, valuation A-, but do factor in the growth grade of a D-. Now, in terms of profitability, always great to take a look at. A+, so the highest score obtainable. I love to see this. A gross profit margin which is above the sector, 43.77, above the 31% of the sector. And when we do take a look at the bottom line, not the greatest, but you do need to understand that 2023 was a one-off, hence why we have the negative number on a trailing 12-month basis. We will come back to this when we do look at that dividend safety as well as the underlying metrics. Nonetheless, when we also take a look at the free cash flow margin, very strong, 27%, sector at 6.56, and even on the other ones, notably the cash from operations, a lot stronger than the sector median at 6.68 billion versus 306 million. Now, we do like to also compare them to how they've performed versus others in the industrials industry. We have a few names here. You may have heard of these, you may not have, but very comparable. What we can see over the last year, 3M is down negative 4%. Now, factor in, this is total return, so it includes those dividends reinvested. They are one of the worst performing. Over the last 5 years, what we can note is that they are also down. We can see clearly negative 38%. Again, one of the worst performing. And even when we zoom out over the last 10 years, you do not want this from any kind of investment. Putting in those dividends every single quarter to get a negative 4% return over the last 10 years. But as you've heard me say many times on this channel, past performance is not an indicator of future performance, but always good as one level of review. Now, insider ownership, very small, 0.38%. We do note 2 instances of insider selling of just under $1 million over the last 12 months. And when we can see the latest one was in Q1 of 39K. And then we have to go all the way to Q2 of 2023 to see 1.62 million worth of sales. Now, when we take a look at who these were, we can in fact see that an insider did sell on the 14th of February 426 shares, a total transaction of $40,000. So it isn't a lot. Again, if you want to include it into your own investment thesis, the transparency is there so you can see. And also, US Congress members, we don't pay too much attention, but again, you can see a lot of movement, but this again is in 2023, so whether or not you believe it is relevant, that is for you to decide when you're looking at your own analysis. Now let's take a look at institutional ownership, 65%, 4.49 billion worth of sales by the institutions over the last 12 months. We see nearly double the buying over the same period. And on top of that, we do see a little bit more buying by the institutions in Q1, the latest quarter. So overall, institutions are buying more over a longer time period, and in the more recent quarter, a little bit more. Now, just before we jump into essentially the dividend safety, we do want to take a look at their investor presentation just to understand what this dividend cut is and how it will affect those shareholders. So this is literally from their slide deck that they did just release earlier today. Now, they are talking here about resetting their dividend post the spin-off or the Solventum spin-off. If you were a shareholder of 3M a few months ago, you would have got 1 share of Solventum for every 4 shares of 3M you had. Now, let's just run through these pointers. The first one is that they have paid a dividend for over 100 years, and it is a competitive dividend. It has been fairly strong for a very long time, around the 5 to 6% level. Now, as I just mentioned, they did distribute a lot of those Solventum shares outstanding to 3M shareholders, so you may have been someone that does have it currently, or maybe you did sell it straight away. Now, this is the main thing to understand here, now that following the spin-off of Solventum, the 3M's dividend payout ratio is expected to be around 40% of the adjusted free cash flow, with the potential to increase this over time. So we're going to take a look shortly at how the percentage has been over the longer term, but just understand moving forwards, it will now be 40% of the free cash flow rather than the higher levels we have historically seen. Now, they do go on to talk about the dividend will be in line with the industrial peers as well as over the S&P 500 median, which it has been for a significant amount of time. The S&P 500 dividend yield has been very, very small, so that it isn't expected to be very hard to compete with. The second thing is the second quarter dividend is expected to be declared next month, and by next month we are talking about May, so it could be very, very soon. So it isn't too long before we find the exact number. The only thing that we do note, given the percentage, it will be lower than what it currently is. And share repurchase, we can see they have stepped back into the market, so they are considering doing those share buybacks. Now, is this a negative sign? Is this a positive sign? Remember, they did have a lot of debt, and with that debt, it does mean there is the risk of cutting that dividend. Now, it looks like they are taking a very positive step by having it around that 40% level, but let me know your thoughts on this as we go along in today's episode and we uncover more information. Now, in terms of their guidance, we can see their 2023 guidance, it wasn't looking the best. They had negative 4.4% growth organically to their top line. They had operating margin of 18.85 to 18.9, and we can see their estimated earnings per share. Now, how are they looking for 2024, the next full year that we have currently just had Q1 reported? Well, they're expecting flat to plus 2%. Now, it's not great. As always, we do want to see a minimum of 3 to 4%, but it is a lot better than their 2023 figure. What's also nice to note is they are expecting an increase on their adjusted operating margin. Although very minimal, it is moving in the right direction, and we can see here their earnings per share is expected to increase very strongly from 2023. So overall, whilst in 2024, if you looked at it in singularity, it may not be the best, they are moving in the right direction, which is always positive to see as shareholders or even potential shareholders. The second thing we just wanted to point out was their growth on their earnings per share from Q1 2023 to Q1 2024, and in fact, we can see very strong growth. 197 was what they had declared and reported in Q1 23, 239 in the latest quarter. And you can clearly see the growth that has happened just over the last year. Now, finally, the other thing that we just wanted to point out, just a few important metrics that we like to always see, and we will look at them historically now. Their adjusted free cash flow, it is down 12% year on year. Remember, the lower the free cash flow, the lower the dividend is going to be, as it is a 40% figure of this number for the total year. And we also can see what I would say is very positive is the fact that their net debt levels are coming down. Remember, the lower the net debt levels, the stronger it is, not just for their balance sheet, but also for the security of their dividend. Now, before we dissect these metrics, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, do click on the pinned comment below. And this article here, how to find undervalued stocks, it is a very highly requested one. We talk about all the websites we use, as we do get a lot of questions every single episode. So do go check them out. In terms of the dividend safety, now, yes, we have a 40 score here, unsafe. So let's take a dive into that and understand. Market cap 51 billion. It is a large cap company. And we can see here they have reaffirmed that dividend safety of unsafe. In fact, just today. So they still do believe that there is a moderate to high risk of a dividend cut over the full cycle. Now, from the information that we have just gone through, there will be a dividend cut, although you could argue that given the fact that they have spinned off another company, it isn't necessarily going to be classified as a dividend cut, but nonetheless, shareholders need to understand that the dividend yield will now be lower. So what about the historical performance in the last recession? Well, what we know, they did in fact increase the dividend during the 07-09 crash. They had average growth negative 13.3%, with the S&P during that time negative 12, so not too far off. And they pretty much had a recession return in line with the S&P, negative 54 versus negative 55. Dividend growth, well, they had an increase of 0.7% in February 24. This was before the spin-off. Very, very trivial, but just to keep in line those dividend increases that they have. And we can see over the last 5 years, it has also been very poor at 2%, which is below the inflation rate that we advocate on the channel. Over the last 20 years, though, we do see 8%. Now, they are a dividend king. They have not just increased dividends over the last 50 years or more, but they have also been paying a dividend for over 107 years without a reduction. In terms of dividend yield theory, now it does state a company is undervalued when the current yield sits above the 5-year average, which we can clearly see. But again, we are expecting over the next few weeks to have a better indication of what the new yield will be for 3M. And we can see on a forward P, as we mentioned, not just lower than the industry average, but also lower than their own 5-year average of 16.4, as well as we can clearly see here the sector trading at around 19.4. So remember, we never look at any of those models in isolation though, and we will conclude towards the end. So why is there going to be a dividend cut? Well, firstly, we just want to point out, not only do we only focus on the free cash flow payout, as earnings is susceptible to manipulation by management through accounting, but so do they at 3M, hence why they said 40%. And as always, what we want to see is below 60%. This is a very good indicator to us that management will be able to offer those double-digit dividend increases. And in 2023, it was sitting at 66%, 2022 at 88%, and if they were to maintain the current yield, it would be at 94%. So right now, it is going to be drastically reduced down to 40%, so we are expecting a much lower yield, something that you should understand as an investor, or if you're a potential investor, it might be positive news, as it means that debt levels will start to decrease rather than taking on a significant amount of debt just to continue to pay that dividend. Free cash flow, what do we love to see? We want to see increasing free cash flows year on year. Now, yes, if you looked at it purely from a 2014 to 2023 basis, it has increased, but also note it has been very inconsistent year on year. In fact, from 2020, it dropped from the highs of 1140 down to 679. Now, also factor in FY24, it is expected to drop down to 642. And as we saw on their investor slide deck, they also saw the free cash flow drop down double digits over the last quarter. Sales growth, not much to mention here other than the fact that it is very poor. We did analyze it, and as we said, when you compare it and factor in the inflation rate in real terms, it is dropping. Now, the positive to note, after the spin-off, they are expecting to turn this round to 0 to 2% for the full year of 2024. Yes, it's not great, but it is ultimately moving in the right direction, and that's what you want to see with a company like 3M that has been hammered for such a long time. Now, sales, again, just another format to see what we previously went through. And when we take a look at these shares outstanding, not only is it nice to note it has reduced over the longer term, so in fact returning that excess cash, but also they are essentially considering doing more share repurchases over the longer term, as they clearly stated in one of their points on that investor deck. ROIC, double digit is what we love to see, around 10% or more, just to give us faith that management are able to effectively allocate their capital. Whilst it has decreased over the long period, from 2019 it has been fairly stable in the 20s. That is a very strong sign and something that investors do love to see, making it a very attractive purchase at the right price. Margins, yes, we want to see above 12%. We do know operational inefficiency as it has been decreasing, but again, they are expecting now to have increasing margins over the longer term. That is one of the things that they clearly do look at in terms of their numbers. So positive to see, not only is it above 12%, but they are anticipating the margin to increase alongside their top line revenue. Free cash flow margin pretty consistent over the longer term, so that is very healthy, as well as above 5%. And when we focus on the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, we can clearly see it is well below the 3 we want to see as a maximum, which indicates that in 2023, it would take them 1.33 years to pay off all of their debt net of cash on hand. Remember, this is important because it correlates to the dividend safety as well as balance sheet strength. Whilst we note it is expected to increase into next year, we can see, as we mentioned earlier, their net debt levels did drop by around 10%. So there is a positive signs, a lot in fact in this company, but it will depend on what type of investor you are, whether you do want to look at value or whether you want a company that is strong right off the offset. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Let's jump into the valuation. Now we're looking at two models today. The dividend discount model, where we have the yearly dividends, as we can see the growth, very poor, average just under 1%. Now forward looking, we would say it's conservative. Yes, it is above the average growth, but the fact they are lowering down that free cash flow rate to 40%, we would expect to see some nicer increases at a minimum 1.75% that we have indicated. And we have a small sign of undervaluation as it isn't too far off the current market value. But as always, never look at any of these models in singularity. We will conclude at the final slide. The DCF model, then we have the free cash flow year on year, average growth rate just over 1%. Now forward looking, we have gone conservative in our opinion at flat, so 0%. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we do get a massive undervaluation signal. Bear in mind, this is on the premise that the growth rate will not be increasing over the longer term. Now, in terms of the intrinsic value, it is just the average of these two models that we have just gone through today, getting to a total value of $113. As always, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on the pinned comment below. You can even go through this same example with your own estimates and judgments too. Now, margin of safety, we start off with 10%, and we use that if it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for 3M, it looks to be a buy at just under $102 at 15%, pretty much right now. So we do see it trading based on our estimates and judgments at a 15% MOS level. How about Wall Street? Well, as we can see, they forecast $106. They do believe there to be upside of 11%, but as we said at the beginning of the episode, all 3 analysts do believe it is currently a hold. So in conclusion, 3M, they will be reducing that dividend. Whether or not you classify it as an official dividend cut, it will be lowering the yield moving forwards, given the spin-off. As always, though, let us know your thoughts in the comments below. 15% MOS level with upside of 11%. Is that something that interests you over the longer term? Is it on your watch list? Or maybe you're a shareholder considering to sell? Now, personally, this is one that I do hold, and right now my strategy will be to hold the position, very similar to what the analysts have said. It will be interesting to see over the next few quarters how the spin-off will have affected 3M, whether or not it will strengthen them. And to be honest, I do like the fact that they are reducing those dividends. It does give the company a bit of breathing room, as earlier on in the year we did notice that their debt levels were very high, and hence why we saw that dividend cut being a very unsafe level. As always, let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.